Hello everyone, and welcome to my video on adverse selection. If you're studying for your property and casualty exam or relating adverse selection to auto insurance, this is the right video for you. However, for those who are studying for life and health, it is similar in content, but can also be confusing as there are only references to auto insurance in this video. Oftentimes, adverse selection is explained using life and health insurance scenarios. What I've observed is that property and casualty learners get confused with the explanation of adverse selection in life and health insurance versus the explanation for adverse selection in property and casualty. It is still the same concept in both, just different scenarios. So in this video, my goal is to explain adverse selection, adverse risk, and provide you with some examples to help you to better understand adverse selection in the property and casualty insurance world. So first, let's talk about risk. The basic definition for a risk is the uncertainty or chance of a loss occurring. If a risk is taken, there's a potential for a loss to happen. We take risks every day, doing normal everyday activities. For example, driving to work, cooking dinner at home, walking across the street. There are risks in everything we do in our lives. We are mainly going to focus on adverse risks. So the best way for me to explain an adverse risk is by first looking at the Latin word adversus. At least I think that's how that's pronounced. Don't judge me. So adversus, meaning turned against, adverse is something that negatively works against something. It is unfavorable and can negatively impact something. An adverse risk to an insurer is a risk that can negatively impact the business. So insurers will try to protect themselves from adverse risks during the application process, which is the beginning of applying for insurance. Adverse risks are risks that are prone to losses. If not managed correctly, insurance companies can go out of business for having insured adverse risks. Adverse selection is when an insurance company insures certain risks that are prone to losses. They take on adverse risks. So you may ask, why would an insurance company take on a risk that is prone to losses? Insuring someone who presents a higher risk can be bad for all who carry insurance in that company because it can cause an increase in rates for all of the policyholders. If an insurance company is paying out more than expected for claims due to the risk the company carries. Insurers try to protect themselves from adverse selection. They have the option to refuse insurance or restrict coverage or even charge a higher rate to mitigate losses from an individual who presents a higher risk than the average risk. Sometimes adverse risks are not identified by insurers because a lot of times the customer or insurer may not be honest during the application process, which can cause the adverse selection. So here are some examples of certain categories of where adverse selection can occur. Location can pose an adverse effect if insurers are not charging enough premium. Location is a big factor because some areas have a higher crime rate than other areas and are prone to break-ins, car thefts, vandalisms. So insurance premiums will vary based on location by zip code because of this. For weather, locations that are prone to natural disasters, such as hurricanes, may see higher premiums. Um, as far as climate, areas where you have fires, you'll notice that home insurance rates are up the roof, or in many cases, not even offered in certain areas that have the type of climate where are often fires in that area. Adverse selection can occur when the applicant gives false information on their application. Some people realize that they're an adverse risk and they will falsify information on their application in order to pay lower premium. For example, if a person uses an address on their application where rates are very low, but actually they live and keep their vehicle garaged at an address where rates tend to be much higher, chances for vandalism and theft are greater. The risk is greater, but the premium they're paying or that the insurance company has collected is not enough. Claims like this can cause inefficiencies in the insurance business. For auto insurance, a person who has multiple at-fault accidents under their belt will tend to pay more premium than someone who has no accidents. New drivers tend to pay more than experienced drivers. Falsifying information, such as not providing the correct driver, can also be an adverse selection, benefiting the customer but adversely affecting the insurance company in the event of a loss. Adverse is something that negatively works against something. So, adverse selection is when insurers insure or take on certain risks that are prone to losses. In property and casualty insurance, this typically will involve one party, mainly the insured, gaining an insurance at a cost that is below their true risk level. That's the video on adverse selection. Thank you so much for viewing my content. Please like and subscribe. Again, I am Rebecca, your insurance lady. Have a great day.